What is good, YouTube? We are here with the start of the longer form videos of this series. This is going to be episode 7 of the Den Academy, which is beginner ICT concepts. We've covered fair value gaps and we've covered liquidity. You guys know what highs and lows are. You guys know where fair value gaps are. You know how to spot them. This is how the markets move. This is how you're going to read your bias. This is how you're going to form your bias. This is how the markets go, right? This is how I trade. It all comes to internal versus external range liquidity, right? So hopping into this, internal, which is abbreviated IRL, internal range liquidity, are your fair value gaps, right? Imbalances in the market are your internal range liquidity marks. External, which is abbreviated ERL, external range liquidity, is your highs and lows. Now, how does this correspond with each other? Internal to external, we rotate from these levels every single day. If we are hunting a high or low, we are hunting external liquidity. If we're trading into a fair value gap, we're hunting internal range liquidity, right? That's literally how the markets move. We're trading to one of these two things, nothing else, right? So how do you identify in or external range liquidity? All it comes down to is highs, which is up here, which becomes your buy side, and lows, right? This is all it is. Your external becomes the buy side, your external becomes your sell side, right? And within this range, this high and this low, this also becomes external range liquidity, right? Whenever we take these highs, this is still considered external range liquidity. This is just the highest high, right? So if we're looking at a daily chart and this is our high and this is our low, we want to be looking to trade to this high. These would be your lower time frame external liquidity marks, right? So what happens when we take this high, right? What's the first thing? Well, we displaced above swing highs, important fair value gaps, with a fair value gap. We trade into it and then we purge external liquidity. We will then return back to internal range liquidity. After that, this becomes a new mark for your external range liquidity, right? Once we form a new high or a new low, it becomes external range liquidity, right? And then right here, we displace above this high, return to internal, and then we purge the external buy side. Now, this would be the exact same thing if it was a bearish example. The external becomes your sell side, right? So these become your external sell side levels, right? And then right here, this becomes internal range liquidity to then target external range liquidity. So all we do is after we purge external, we look to trade back to internal. After we trade to internal, we look for a reaction and then we look to trade to external, right? So this is all it is, right? So this is external versus internal range liquidity, right? Highs and lows and fair value gaps, right? So we're on the silver chart. We'll start on the weekly and I'm going to show you guys just how simple this is, right? So in this range right here, we have a high and we have a low, right? So we come up and we purge this high. What happens after that? Well, we break a swing low with a fair value gap, right? So we are going to look to see if we trade into here. Oops, I didn't even mark that off right. If we trade into here, we're going to be looking to target this external range liquidity on the lower time frame, right? Why this low and not this low? Well, it's because we didn't tap into this fair value gap after before taking this low, right? So let's go into replay here, right? So if we just go down to the daily chart, we can see this has become a prominent low, right? This is our weekly fair value gap. So let's head down to the 4 hour. We tap into this weekly fair value gap. Sorry, I was going to say 4 hour fair value gap, but I realized that we're on the 4 hour chart, right? And we're looking to target the external liquidity because we have tapped into internal range liquidity, right? So what happens? Well, we're grinding higher, and then we displace lower, right? So let's speed this up until we take it. Okay, there we go. What do we have here? This becomes internal range liquidity after taking an external low, right? And then what do you target after tapping into this on the lower time frame? You have to think, if we are day trading and we have a higher time frame analysis, how are we going to get on side for the day, right? So we tap into this 4 hour gap. we're not going to be targeting this sell side off of this 4-hour gap if we're day trading, right? You have to think about that, right? So silver, this is an entire dollar move. That's most likely not going to happen in a singular day. Okay, so we target this external here, right? So internal to external. See how that works, right? And then you guys see that we displace towards this low on the higher time frame, the 4-hour, to take that external on the weekly, right? So you guys see internal to external here, right? So let's see. Why is this going so slow? Let's leave here, right? So after taking this external low, we actually grind up higher and then we displace towards this low and take the range low, right? So after that gets taken, we're going to look to see if we respect this, we would then say this is the next low that we take. However, you guys see, we do not respect it. We come up and we take external range liquidity. What becomes the next target? Internal liquidity, right? So right here, we trade into that internal. We then look to target external, which becomes this high here. What happens? Displacement through that high with a fair value gap, right? Now you guys see we do disrespect it a bit, but then we reclaim it here and then we tap it once again before taking off, right? And then you guys see we open up all these fair value gaps, and then this is where we are now. So what happened here? Well, since we're at all-time highs, right? This is whenever silver went on an absolute rampage. Right, so we come up, we absolutely blast through all-time highs. So external range liquidity is taken. We tap into internal range liquidity here, and then we take external range liquidity. Right, so this is all it is. So if we head down to the 4-hour, we tap into this internal range liquidity. Right, so we're going to look for a reaction off of it. Right, oops. Let's get, this is our weekly fair value gap. Right, and we take this low here. So this becomes external, this becomes external, right? Because these are the most prominent highs in this price leg lower, right? And this becomes external. So what happens here? Well, we don't fill out this fair value gap here, but there's a reason why we don't. Let's just say something else tapped into it. I can't really get into what, because that's further down the line, right? So right here we take it. If we go to the daily, you guys can see, well, I don't know why that's like that. We take this high here on the 4-hour and return to a daily fair value gap. We disrespect it a bit, but then we just go to external range liquidity because of the weekly chart, right? So let's head over to NQ and I'll give you guys some fresh examples. All right, so we're just going to start straight off of the daily chart just so you guys can understand how the higher time frames are moving, right? So you guys see we have this nice price leg lower, and we displace higher right here. We open up a fair value gap, right? So fair value gap comes into play, and we have external up here, right? So we purge external. What do we return to? Internal, right? So we have a fair value gap there. We have a high right here. This also counts as a fair value gap, right? So we have a fair value gap here. After taking this external, what happens? We retrace back into the internal, right? So we take external, all these highs up through here. We return to a fair value gap, right? And then we target external liquidity, right? Taps the internal, taps the external. What do we have here? Internal range liquidity, right? So we retrace back into it, excuse me, and then we target external range liquidity, right? So we tap it, return to external, and then we kind of chop around a little bit. Let me mark off all-time highs so I know where it's at. Okay, so what happens after we take all-time highs right here? Well, we return to internal range liquidity, right? And then we take external, which is this high here. We chop around a little bit. We take an external high. We return to internal range liquidity. After taking or hitting internal range liquidity, we come back up to external range liquidity, right? So you guys are seeing how this plays off, right? Then we have the sell-off. That was about news, so just ignore that, right? So right here, we kind of have just this large range, and then we take this low and we rip higher, right? We return to internal range liquidity here. So we target external range liquidity, right? And then we come back down to internal range liquidity. We return to external range liquidity, right? So I could keep doing this, but we're going to go down to the lower time frame so you guys can understand how to target on the lower time frame. So we're going to go to the hourly and the 4 hour now. All right, so here we are on the 4 hour chart. We can just start off right over here, right? So what do we have right here? All right, this is just accumulation. We're just chopping around. And I'm going to show you guys a bearish example and bullish example, right? But we haven't went over any bearish examples yet, right? So right here, external range of liquidity, and it gets broken through with a fair value gap. So this becomes internal range liquidity. Couldn't even think of what I was about to say. What do we look for after that? Well, this now becomes our external liquidity. And you might be thinking, why does that become external liquidity? Let's just go down to the 15 minute. Right? If we go down to the 15 minute, where's our low at? Right? This is that 4 hour low. If we're looking at this, right, this is market open right here. We have no other low here on this 15-minute chart if we're zoomed in like this. So this is why it becomes external liquidity, because it is a prominent low on the lower time frames, right? Even if we just, hold on, just go back to the daily chart, and if we even just go right here, right? If we just go right here and go down to the hourly chart, we have no other high here other than this high here, which is the most prominent high in this price leg lower, right? And take a look. We make equal highs here, and we took external all throughout here. We return to this internal range liquidity before, oh, we made equal highs there, before purging that external range liquidity, right? That's why you mark off those highs that don't look like external, right? Because this isn't a prominent high on this time frame, but once you go down to the lower time frame, it becomes your prominent high. And once you learn about reversal candles and on the daily chart and reversal candles and continuation candles, then you will understand why we target these highs, because of it becoming an external high on the lower time frames, right? So I just wanted to cover that really, really quickly. Right, but returning back to the 4 hour, so now you guys understand why this becomes your external range of liquidity, because it is on the lower time frame, right? So looking here now, right, so what happens here? Well, there's actually a reason why we don't come back down and take this low immediately right here. But if we just go down to the hourly chart, and there's a reason we don't take this high. I just can't get into some things right now because you guys haven't learned about it, right? So right here, there's a reason we don't take this high. Let's say ES did. We have this fair value gap here. We respect it here. What becomes your external? Well, this low right here, right? Now you might be thinking, well, doesn't this? Yes, it does. However, whenever we go down to the lower time frames, you're not going to be targeting all the way down here, right? Because, like, if we just go down to a 5-minute chart, at the time, this looks like the most prominent swing lows. You're not zoomed out like this, right? Now, yes, this obviously could be a draw on liquidity for the day, but this is the most obvious external low whenever you zoom in like this, right? So even if we just take a look here, we take the external and we return to internal here, right? And once again, like you guys can see, we take the external, return to internal here, and then we take this low, right? So you guys see, like, it works on every time frame. It's just pairing it with bias and everything. Okay, so we hit that 1 hour gap. Let's actually go back to the 1 hour. Right, so we hit that 1 hour gap, right? And then right here, we open up a new 1 hour fair value gap. So if we're gonna respect that, what becomes our external range of liquidity? Well, it's right here, this low. Right, and then we purge all this, we just dump straight lower, and then we reverse, right? So this is how you can tell it's a reversal. It's expansion with expansion. So this is a V-shaped reversal. Literally, if you just look at it, right? What's a V look like? Just drag it over, right? It's literally what it looks like. That's your most prominent signature in price. Okay, so if we clear all this, what do we have here? Oops, what do we have here? We have a external high, and we have a fair value gap, right? This counts as a fair value gap, okay? So what happens here? Well, we purge external, so we return, we have one down here. So we return to internal, and it's probably a 4-hour, right? Yeah, it's a little 4-hour gap here, right? So we take this high, and then we return back to internal range liquidity, and then there's a reason we don't take these highs, right? But right here, we take this high, and then we displace lower with a fair value gap, right? So we tap into this fair value gap. So what becomes your external draw? Well, you could literally just mark this low, because this low, and this low are so close, and this low, right? So all these lows are super close, so you can just mark off one of them, whatever your most prominent swing low is, whatever you think is the highest probability, right? So if we take a look here, what do we do here? Well, we take external range liquidity, so what do we return to? Internal liquidity, right? So you guys see how this is working, and how you can, like, that. It's literally just how you can understand simply how the markets move from external to internal, right? So you, like, that's probably the best example of external to internal, right? So even right here, we take an external low. So if we're looking to trade from here, what do we want to target? Like, if we're not confident in this high, well, right here, right? So external to internal, even though we rip through it, it's still a very easier draw on liquidity, right? So what happens here? Well, we take external. So what do we target? Internal, right here, right? Right here, we take external. What do we target? Internal, right? And then even though we run them intraday, it is your highest probability draw, because it becomes, let's go to the 15. It becomes, ooh, not on this one it doesn't, but you could just mark off this high. It becomes an external draw on the lower time frames, right? So whenever you're looking at a higher time frame internal fair value gap, it most likely all the time becomes an external draw on the lower time frames, right? So if we just take a look at the 15-minute chart, right? None of this looks really clean though. Okay, well, right here, right? We take external range liquidity, we return to internal range liquidity, we return to external range liquidity. See how, like, it's that's earnings. That's why this looks so sloppy, because of this wick. I was wondering why this looked so weird. It's because of earnings right here, right? But you guys see right there what happens here. Well, we have internal range liquidity. We are targeting external range liquidity. All right, so internal to external. What happens here? We take external, we return to internal, right? And we kind of disrespect it, but then we reclaim it. And then we target external. What happens after external? Is that a fair value? Yep, small fair value gap. We tap into internal, and we return to external. Right, so let me see, is there a bearish example here? Right here. Now you might be thinking, well, internal, where's our external? It becomes this low here, because remember what I said, if we go to the lower time frame, it becomes an external draw, right? So, like you guys even see here, we take this low and we return to a fair value gap. It doesn't matter when. This, like, it happens on every single time frame. Every time frame it happens. We take this low, we return to internal. Right? So, sorry, someone texted me. Like, you guys see how, like, simple, like, I'm making it. You can't understand the markets in a simpler way, right? I don't know what to say. Like, this is the most simple way to understand how the markets are moving. We tap into internal range liquidity here. What do we target? Oops. External liquidity, which lies here. Right? We displace away from it. We take out these external highs. We return to internal range liquidity, which lies here. Right? What happens? We purge external, and we return back to internal range liquidity. Oh, did we? Looks like we made equal lows. Yeah, we made equal lows there. That's kind of sus. Right? I don't know how else, like, we could keep doing this, but I think you guys can understand how, like, the markets move. Like, if we just go all the way back here, okay, what happens? Internals hit, external becomes the draw, right? And you might be thinking, well, how are we going to know if it's going to be respected or disrespected? That comes with understanding reversal candles and continuation candles, which is later on in the series. This is just understanding that the markets move from internal to external liquidity. What happens here? Well, we return back to internal, disrespected a little bit. I'm guessing something took out this low. There's a reason. Is this a new weekly open? Monday, yeah, this is a new weekly open, so there might be a weekly gap here. Yeah, there is a weekly gap. So if we go to ES, maybe YM. Okay, so let me see where this is. It's 30th of May. 30th of May. 30th of May. Okay, so that was YM displacing higher and NQ consolidating. Oh, wait. Yeah, that's what it was. Okay. Right. Okay. Now that, like, I can't get into some of this stuff, but where was I? It doesn't matter. It's the same thing on every time frame. All right. So here we are. We can do this one, right? So we take external, we return to internal, right? These are the last examples I'm doing, right? So we take out this high, we return to internal range liquidity, right? And why aren't we targeting internal to external here? Well, we've already taken the external, so we target from external to internal, and then we see the reaction. As you guys see, we displace away from it, we take out this external here. What do we return to? Internal range liquidity. And then we hit external range liquidity, and then we displace heavily higher, and we don't, oh, we have one right here. Wait. Yeah, that is one. Is it? Nope. Sorry. Right, okay, sorry. Right here. Internal to external. And then we purge these lows, right? So we purge these lows. So external is taken. What can be our draw? Internal range liquidity, right? We run the internal range liquidity. We take external. We return to internal. What happens after that? We take external. What do we target? Internal, right? I mean, and then we take this low. We don't have a fair value gap here to target. We displace above these highs, tap into internal, target external, right? And I guess I can say this because why not? External is also previous day high and previous day low. Why? Go down to your hourly chart. What does it become? External range liquidity. So what do you target after external range liquidity is taken? Internal range liquidity. Boom, right? So we're just here on the hourly chart. We take external. This is our daily internal. We return to internal. Like, I think I have to call it here, right? It's as simple as it gets. I can't just keep doing this and boring you with the same exact things. This is how the markets move. It's the easiest way to understand how the markets move. And that's that. So, hope you guys enjoyed this video. I'm going to get out of here. I'll see you in episode whatever's next. Peace.